Welcome back. Today, we are deep diving into one of the hottest stocks in the Indian Electronics Manufacturing Services, or EMS, space, Kaynes Technology India Ltd. As India pushes for Atmanirbhar Bharat and the global China Plus One strategy gains momentum, companies like Kaynes are moving from the sidelines to center stage. But is it just hype, or does the fundamental growth justify the massive stock price surge? Kaynes isn't just about assembling parts. They are integrated players in the electronics value chain. From automotive to aerospace, their footprint is expanding rapidly. In this video, we will break down their business model, their foray into semiconductors, and whether this stock is a multi-bagger for your portfolio or an overpriced risk. Let's get started. What sets Kaynes apart is its incredibly diversified revenue base. Unlike some competitors who might be overly reliant on mobile phones or consumer electronics, Kaynes serves mission-critical sectors. Automotive electronics currently contributes about 35 to 40% of their revenue, followed by the industrial and medical segments at 30%. They also have a significant presence in high-margin sectors like aerospace, defense, and railways, which contribute roughly 15%. This diversification acts as a hedge. If one sector slows down, another compensates. For an investor, this means stability. They aren't just making gadgets, they are building the brains for electric vehicles, ventilators, and signaling systems for the Indian railways. This multi-vertical approach is the core of their high-margin strategy. Let's talk numbers, because the growth here is nothing short of explosive. Over the last few years, Kaynes has maintained a revenue CAGR of nearly 60%. Their EBITDA margins are industry-leading, hovering around 14 to 15%, which is significantly higher than many of their domestic peers, who struggle at 6 to 8%. Their profit after tax, or PAT, has seen a massive jump, reflecting operational efficiency. As of the recent quarters, the company is maintaining a healthy return on capital employed, ROCE, and return on equity, ROE. This financial strength allows them to reinvest in R&D and capacity expansion without over-leveraging their balance sheet. For seasoned investors, these margins are a clear indicator of their design-led manufacturing advantage over assembly-only models. Why is Kaynes enjoying such high margins? It's because they aren't just an EMS company. They are moving toward being an original design manufacturer, or ODM. While traditional EMS companies just take a blueprint and assemble the product, Kaynes gets involved in the design phase. They help companies design the PCBs, optimize the components, and build the prototype. This design-to-manufacturing capability makes them sticky. It's very hard for a client to leave once Kaynes has co-designed the heart of their product. This competitive moat is what protects their 15% EBITDA margins in a world where pure-play assembly is a race to the bottom. They're essentially a tech company with a factory, rather than just a factory for hire. The biggest game changer for Kaynes is their entry into the semiconductor space. They have announced a massive investment of over 2,800 crore rupees for an OSAT facility in Telangana. OSAT stands for Outsourced Semiconductor Assembly and Test. As India looks to reduce its reliance on chip imports, Kaynes is positioning itself to be one of the first private players to have a functional semiconductor packaging unit. This isn't just an expansion, it's a total transformation. Semiconductor packaging is a higher margin business and places Kaynes in an elite group of global suppliers. If successful, this project could double their valuation in the long run. However, the gestation period is long and the capital intensity is high, making it a high-stakes bet. Future revenue visibility is crucial for growth stocks, and Kaynes doesn't disappoint. As of the latest filings, their order book stands at over 4,115 crore rupees. This provides a clear revenue runway for the next 18 to 24 months. To fulfill these orders, they are aggressively expanding. They have 9 manufacturing plants across India, including key locations like Mysore, Manasar, and Bengaluru. Their capacity utilization is increasing, and they are setting up new facilities to cater specifically to the export market. With the China Plus One strategy, global OEMs are looking for reliable partners in India, and Kaynes' scale makes them a primary candidate for large-scale international contracts. No investment is without risk. For Kaynes, the biggest elephant in the room is valuation. The stock currently trades at a price-to-earnings ratio of over 100x. This is exceptionally high and implies that the market has already priced in several years of perfect execution. Any slip-up in earnings or delay in the OSAT plant could lead to a sharp correction. Additionally, competition is heating up. Global giants like Foxconn and domestic rivals like Dixon Technologies are also expanding their footprints. While Kaynes has a niche in industrial and defense electronics, the macroeconomic environment, rising interest rates, and global supply chain disruptions for components remain key risks that every investor must monitor closely. So, what's the final verdict? Kaynes Technology is a high-conviction growth story fueled by India's electronics revolution. Its transition into an ODM player and its bold entry into semiconductors make it a unique asset in the Indian market. For long-term investors who can stomach high volatility and high valuations, this could be a cornerstone of a growth portfolio. However, for those looking for a value buy, the current price might seem daunting. The key will be their ability to execute the 2,800 crore semiconductor plan. If they win there, the sky is the limit. Always do your own due diligence and consult your financial advisor. What do you think? Is Kaynes in your portfolio? Let us know in the comments below.